This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, good everyone, how you going? Phil Tarrant. I'm the host of the Smart Property Investment Show. Now well over 1,000 episodes of this podcast. Who would have thought that the market would put up with me chatting so much around property, but it seems to just keep growing with strength, and we're getting more and more listeners every single week and month on this show. So thanks for tuning in. We do enjoy presenting this. It's just not myself behind the microphone. It's a great team here at Momentum, including our managing editor, Grace Hornsby, who leads the team, and our production crew under Lindsay. They do all the heavy lifting. I get the good job getting to speak to people that know about property, which is always great for my own education. But I do enjoy being able to have these conversations, help extrapolate information to help you make more informed property investment decisions. And one of the most in-demand podcasts we get, and I'm sort of a bit, I ration them because I can't say the same thing every single week or day or month. A real sort of breakdown of the state-based level right across the nation about what's happening, particularly the capital city level. I find that those podcasts often are the most in demand and they get the biggest listenership. So pretty careful who I bring into the podcast to actually have a chat about these type of things. I need someone with sort of a whole of Australia focus and without any sort of specific bias on where they're buying property. You find that a lot of buyers agents per se, some exceptional buyers agents right across the nation, like particular events and particular areas that they're focusing on. So I try to lean on organizations who have a more holistic approach to education around property, those people that support the growth of people's mindset around property and helping them make those decisions themselves. Just because someone or a whole cohort of investors are investing somewhere doesn't necessarily mean you need to be investing there as well. It's going to be very specific to your own personal strategy and your direction, where you are in your portfolio construction, how long you've been doing with it. It is a very unique thing, property investing. So just don't follow the herd. Often you want to be either before the herd or start the herd, or when the herd is investing somewhere, you probably want to be well away from it. So I want to break down some of those things today at a whole of Australia level. People get obsessed with property data. They get obsessed with hotspots. You need to remember that you don't buy the whole city when you buy a property. You're buying in an actual suburb itself. So just because a certain city is performing doesn't mean that every single property you purchase in that city will perform at the same speed. So these are some of the specializations you have as a property investor. What's the states of the local markets? What's the local market drivers? And everything it comes down to what's actually happening on the ground. When will the market in each capital city change? And they're always changing. Property markets are always changing. And the nature of opportunity for growth in those cities, or whether or not you might be selling down, who knows? We're going to get stuck into it, but we're going to go down to a deep suburb level at all these different locations right across Australia. Joining me in the studio, Simon, Buckingham, and Brendan Kelly. They're from Results Mentoring, good friends of the Smart Property Investment Show. Gentlemen, how you going? Welcome back.
Doing well, thank you. It's lovely to speak to you, Simon.
Yeah, always a pleasure to be here, Phil.
You guys are still plugging away at it, so good to see you're as active as ever. You're growing your cohort of, I guess, your clients that turn to you for support and engagement. Is the attitude and aptitude of property investors getting better over the years that you guys do this, Simon?
Yeah, look, I think you do see change as the sentiment in the market ebbs and flows, but the sort of investors that we deal with are very committed to their financial future, and they have some clarity around the goals they're trying to achieve. Their property investing is for a purpose. And because of that, they're always looking for the opportunities in the market. No matter whether the market broadly is going up, down, or sideways, there are always opportunities. And it's been brilliant to see so many people that we've dealt with over the years adapt to the changing market conditions, grow with the market, even to the point where we now have dozens of people that we've worked with over the years who are fully financially independent as a result of their property investing, which is always very exciting for Brendan and I to see when we get an email from someone who says, "Hey, I just quit my job. I'm just doing my property full time now." Just awesome.
So it does happen.
Oh, all the time. Every year we get more and more. And this last year has been no exception. We've seen people making 5, 6, and in some cases even 7+ figure profits out of property deals that they've been doing. So there's opportunity in every market. One of the things you've got to do, I think, is stop listening to the news, reading the headlines, read past the headlines and understand what's really going on in the market and where the opportunities are.
I think that's what you guys and results do very well, and that's sort of changing people's mindsets around it, and people get immersed and obsessed with what's happening in the media, and it really sort of dictates their attitudes towards property and their investment decisions. So I could probably try and explain, Brendan, what you guys do, but I'll probably butcher it. So for those of our listeners that aren't really familiar with results mentoring, like what's the breadth of what you guys do and how you do it?
Broadly, we cover. It's just huge, and to pinpoint it is really quite difficult. It's not a case of this is what we've done, you should too. It's a case of we've done enough. We've done a variety of different strategic approaches over many years and a couple of decades of this now. And we've had success across the board. And so we get to look at where people are at. Then we can see fairly clearly where they're going, and we just simply shine the torch on the potholes in front of them to help them to make better decisions on the journey that they want to go down. We're just looking to support them to what they want to achieve, whether it's I want a better portfolio, whether it's I want to be out of work in 5 years, whether it's I'm nervous about whether super is going to do it for me, I need a better retirement plan. Whatever the journey is, if they have a passion for property and want to do something great out of property, then we can help support them in what they want to achieve their way by highlighting the things that they just can't see. Yeah, and that's where we skill up. That's the win that we can provide.
Well, there's a lot of, what's the old adage around sort of known knowns and known unknowns? For most property investors, there's a lot of unknown unknowns. So unless someone can sort of point them out to you, you're not going to know they exist. And I'd rather someone tell me about it before I, to use your analogy around potholes, fall into it.
Yeah. So it's interesting. There is no question in property investing that hasn't been answered already. But if you don't know where to go and find that answer, then you may as well be blind. Yeah. So it's a matter of seeing and having access to someone who has all the answers to be able, or has got enough knowledge to be able to pinpoint the direction of those answers for then the answer to become visible for them. It's yeah. And this is where Simon and I get most of our joy. The aha moments of people going, oh, I can move forward now. I'm not stuck. That's the sort of thing that we drive for.
Yeah, I guess we're investing in property in Australia today is very different than what it would have been 20 years ago. There's so much more education. There's so many reasons why you should make mistakes now, because there is so many people sharing knowledge and information around it. But still, people go down this pathway and these journeys saying, oh, I'm happy to make mistakes. It's all part of but you don't really need to when it comes to property. To your point, Brendan, most of the mistakes have been made. They are avoidable if you know what to look out for. And if you don't know what to look out for, go and find someone that can help you out. And it's the reason why we have a cohort of property investment professionals supporting it now, Brendan. So let's get into the market, because this is what I really like to get stuck into. And there's markets within markets. We all know that. Navigating Australia's multi-speed property market. So it's not even a two-speed market. And you sort of hear that getting banded around a fair bit. Simon, can you explain this idea of a multi-speed property market? Is that just because you've got so many different things moving in unison?
Yeah. So one of the first things you've got to understand about the real estate market in Australia to make sense of it is that it's not one single market. We have over 15,000 suburbs and towns in this country, and about 5,000 of those suburbs have units as well as houses. So you've really got 15,000 house markets and another 5,000 unit markets, or 20,000 different markets in this country. And they've all got a different balance of property supply and property demand, which means they all perform differently. So at its most granular level, it's this mass of different markets that are all moving differently. So that multi-speed market exists on an exponential scale. At a aggregated scale, when you look at individual cities, they're collections of those suburbs. And that collection of differences means that a city itself might be performing differently. So we have some cities that have performed very well. You look at the overall stats for the country, Australia has gone up in value. Australian housing has gone up in value about 8% in aggregate. But what that hides is that you've got some capital cities that in the last 12 months have gone up over 20%, and some over 10%, and others have hardly moved or have in fact gone down in the last 12 months. And so you have this multi-speed situation where if you're not aware of it and you treat your investing a little bit like a dartboard, you could very much end up in a city that's underperforming, and even within a boom city in a suburb that's underperforming. So we need to be conscious that it's not one market, that there are multiple influences, and that the different cities are performing differently at the moment when we're trying to shortlist where we might go and the kinds of opportunities we might want to tap into.
So when you're looking for markets, you talk about shortlisting where you want to go. You want to be looking at, and I don't know any property investor that wants to invest in markets which are going in a negative direction. They all want to invest in markets which are growing. So the art of property investment is deploying your money where you're going to get the most rapid rate of growth at any period of time. And through that, if you've got a large portfolio, you've been doing it for a while, you might have some halcyon days of those properties growing in rapid value, and other times they're not growing as fast. If you're new to property investment and you're trying to build a portfolio, you want to try and get the maximum rate of growth with the money you're deploying, and that means that different markets going to move at different speeds, and that's a skill set. And no doubt where Simon and Brendan spend a lot of their time educating Australian investors. So, a case in point, we'll start off with this capital city, Perth. That had a decade of very little growth or negative growth, and now over the last sort of 18 months, it's had rapid growth. So the rate of growth has been significant. Will that continue, and why is it continuing to grow, or why has it had that growth? I don't know. It's beyond my skills and capabilities, but Simon knows, doesn't he?
Simon does know.
Look, we have a pretty clear idea. I mean, one of the things that we've worked pretty hard on over the past decade is to really understand what drives the market at the lowest level, at that individual suburb level, and then be able to bring that up to be able to analyse and, in fact, forecast the direction of the capital cities. And so we've been watching Perth quite closely over the last 12, 24 plus months, haven't we, Brendan, just to monitor what has been happening. And as you say, Phil, Perth went through a period of time where values came down year on year, particularly off the back of the mining investment boom ending. And it was really in the doldrums for quite some time. But in more recent times, that's really turned around, and the rate of growth has been, you'd have to say, exceptional on a citywide basis, over 23%, I believe, Brendan, in the last 12 months, according to CoreLogic statistics.
So interestingly enough, think of driving a car. You've got distance, speed, and acceleration. You can decelerate a car, but that still means you're moving fairly quickly and you're covering distance at the same time. You can accelerate the speed of a car and you just get to move that distance faster. So what we've seen in Perth since January 23 is an accelerating rate of growth, not a steady rate of growth at 5% per annum steady. We're seeing accelerating rates of growth, which means the rate of growth is increasing. And right now, if we have a look at Perth, the rate of growth is at around 30% per annum. Now, rate of growth, meaning for a short period of time, it's going really, really fast. It's not going to stagnate at 30, or it's not going to be a steady rate of 30% ongoing. But right now, we are at a really high rate of growth in Perth. And you extrapolate that out, and it's around about 30% per annum. And that rate of growth is not over yet. That rate of growth is still going up. So we're going to see in excess of 30% per annum extrapolated for a short period of time. However, that won't last forever. So what we're going to see then is we're going to see the rate of growth ease back in the not too distant future. It'll still be strong, but it won't be as strong as it's been. So yeah, not yet peaked, but not far off.
Yeah, it's not something that's sustainable at that rate.
So Perth is getting faster, is it?
Perth is getting faster, right? Yeah, right now. But again, only for a few more months.
And then the rate of growth will start decelerating,
easing,
but it will still be significant comparative to what it was.
Correct. Yeah. So we'll be going really fast and experiencing great growth in Perth, but not at the rate of growth that we're seeing right now. And it will start to trend back to more of a plateau over the next 12, 24 months.
It's an important concept, rate of growth, because it could just be a moment in time between
Correct.
2 months that you have that speed. You don't get that at an annualized level unless you've been in that market for a period of time. You're going to get the benefits of access to that market and having something in that market. But if you're nearing the top rate of growth right now, I would argue that you probably missed capitalizing on when it's at its fastest, because by the time you go into the market, unless you're buying right this second, you might miss out.
Yes, I hear you. And there are two arguments to that. Yeah. One is If you try and get in now while it's as hot as it is, then you're paying above asking price. You've got to act really quickly. The competition's really tight, and you'll be frustrated by how many you lose because, and again, real estate agents will go, if you don't want it at the best possible price, listen, I'll just pick up the phone to the next guy who's interested in buying it and I'll just sell it to them. So unless you're going really hard with deep pockets in order to commit to buying something, then yes, you're going to be outbid or outcompeted a lot. However, that doesn't mean that the market or growth per se in Perth has peaked yet. We are still moving rapidly, and that the rate of growth will be declining, but the speed will still be increasing until the acceleration hits zero. And that's when we coast at a certain speed. We're not there yet. So it's still getting hot, not getting hotter.
So you could argue using that as a position on it. If you're looking to participate in a market which is driving towards its most rapid rate of growth, in many ways, you're probably a contributor to that rapid rate of growth.
Yeah, you have.
So strategically, you might not want to participate and wait
Correct.
for that steam to come out of it. It becomes more normalized.
Correct.
It's funny how markets work.
That's wonderful. All right. So to that end then, yes, most of the acceleration of the growth has occurred. If you're in Perth already, just sit back and enjoy the ride. It's coming. If you want to get into Perth, not every, now this is Perth as an aggregator, yeah? Not every suburb in Perth has peaked yet. So with clever selection, you can still go and find suburbs that have got growth left in them and an acceleration of growth left in them. But it's going to require you to be on the ground to do some reasonable due diligence with a bit of knowledge and behind you to be able to select that. You can't just randomly throw a dart at a dartboard or a dart at a map of Perth, land on a suburb and go, hey, that's where I'm going to go. That's the best suburb ever. Yeah, because it's unlikely to reach that.
So other than market activity and maybe investors pushing or accelerating the growth in Perth for a moment in time, what else is driving the Perth market, considering a decade plus of pretty lackluster performance of property markets, Simon?
Yeah, so post the pandemic in particular, we've seen a considerable spike in migration into WA. So there's been population growth, certainly putting pressure on the existing housing supply. So it did take some years for what was really an oversupply in Perth to gradually get absorbed. And that was part of the reason why it was so lackluster for several years, was just too many houses and too few people wanting to buy those houses. There's obviously been a bit of a boost in the resources sector in recent times. That's increased labour demand. Yeah, any market is fundamentally, the pricing in any property market, just like any other product, is fundamentally driven by the forces of supply and demand. And what you've got in Perth, what we've seen in Perth, particularly over the last several months, is a massive reduction in the number of listings available, which is effectively the supply of housing. So we're not talking about building new homes here. We're just talking about what's available in the market, what's listed for sale. And if I'm not wrong, Brendan, I believe that's dropped by about 45% since January.
January 23, yes. So over the last 18 months, we've seen a 45% reduction in listings, and the trend is still declining. So the amount of stock that's being listed, fresh new listings, is being snapped up faster than the base supply. So we are still diminishing in the volume of listings. And investor activity over there has been very strong. So the word around the country is go to Perth, go to Perth. So all investors have gone, yep, cool, I'm out. Particularly Victoria, yeah, I'm out. I'm going to Perth. So they've gone to Perth. The value of investors' loans in Perth right now has had a 5-fold increase since pre-pandemic levels. So investors over there were spending in the order of $250 million a year, in the order of. It's now $1.23 billion a year. So the investor market in Perth is significantly lifted. That's also because prices have lifted, but you've got an increased volume and an increased price. So you've got a lot of money coming into Perth. That makes people very happy and helps elevate price over there. It's the highest it's ever been, still growing.
Yeah, and the mind boggles the speed at which the Perth market kicked into gear and started accelerating. And I was chatting about it right through the pandemic at Perth, and essentially indicating something's about to happen, but just be patient. But when it did happen, it sparked, that ignited, and it's gone absolutely berserk. And a lot of it's been investor driven. I spoke with the head of a very large broking division of a major bank today, and they said investor loans are on the up. And I sort of went, is it in Perth? They couldn't give me the specifics around it, but it is driving a lot of activity. So considering all this and this concept of the rate of growth, but the rate of growth can come down, but still be accelerating a market in a positive way. How much has Perth got left? Have you missed it if you're talking about or thinking about investing in Perth now?
If you get in now, there's still growth. There is still enough growth on a cold, hard dollars value. So we're talking distance now. Yeah, the speed with which you get there won't be as fast, but the distance covered, there will still be enough lift in value to have enjoyed a purchase in Perth if you buy this weekend.
This weekend.
Yeah. Or over the next month or two, let's say, yeah? Or for a little while longer. There's enough growth in there for 12 to 24 months before it starts to really ease off significantly and you'll notice it. But there's still lift to go. Now, the dilemma you face is the buy price getting in the competition you've got to face. If you're willing to do that, then yes, you will see a dollar lift on the property that you purchase over the next 12, 24 months.
So don't assume the same rate of growth, but expect growth. What's going to be the key indicator for you guys when it's time to not be investing in Perth anymore because the value of deploying your money there isn't as good as what you'll get somewhere else? What's going to be the telltale?
The rate of growth drops back. When you see a rate of growth dropping back to under 10%, it's still in growth, but it's under 10% per annum. When you see the volume of listings plateauing out and the number of sales starting to decline a bit perhaps or plateau out, if you've got plateaued listings, plateaued sales, then you've got pretty much a steady market. And to that end, you go, okay, if I'm going to ride waves of growth as an investing strategy, then I need to get out around then while it's still warm, not cold, still warm, not neutral, still warm, and there's still competition for tail end investors, tail end owner occupiers after a wave of growth, then that would be the time you'd want to get out, which again, 12, 24 months, probably more like 24 months from now.
So we're going to go right across Australia, but I want to give sort of some more emphasis on markets like Perth. So we've done it at depth and also Brisbane, which we'll get to in a moment. Some of the other markets we'll probably go a little bit faster through, but stay with us, everyone. Back in a moment. When we get back, we'll break down the Brisbane market. Welcome back, everyone. Phil Tarrant from Smart Property Investment, chatting with Simon Buckingham and Brendan Kelly from Results Mentoring. Now, gents, Brisbane I've had property in Brisbane for probably nearing a decade, and I spent probably the first 3 or 4 years waiting for something to happen, and now things are happening. So it has been a good investment. And back to that idea of Perth, because I'm in the market, and when a rate of growth actually takes place, I'm not scrambling to enter the market. I'm actually there. So it's not a bad place to be in. Simon, what's happening in Brisbane at the moment? What's the sort of base case for the rate of growth there?
Yeah, sorry, I had to laugh at your story there, Phil, because for many years Brisbane was always going to be the next capital to go, wasn't it? It's going to be the next boom, and then somewhere else would boom. And that's going to be the next boom,
after Dublin in Sydney over sort of 2 and 3 years, sort of going up there thinking, all right, here we are again. Yeah. Where is it?
So, exactly. So it did have very anemic growth, but eventually it got there, and really about before the middle of last year, it really started to take off and hit a very, very rapid rate of growth. And it's kind of held that rate of growth since then. It's been at very healthy double-digit percentage growth for over a year now. So what we're seeing, though, is when you start to look at that balance of supply and demand again, you've got this downward trend in the available stock. So listings are well down, I think about 24% at last count, Brendan.
Yep, that's correct.
Since late 2022, and they're still trending down. And it's less than half the number of properties in the market in Brisbane than were on the market pre-pandemic. And that's a big part of this. Just people aren't selling their homes, but people are moving to Brisbane. People are buying in there. So it's had more than its fair share of recent interstate migration. And so that's put real pressure on the existing housing supply. As we all know, we're not building lots and lots of new houses at the moment, so there's no help there. So if people then aren't putting their homes into the market, and in fact, fewer people are listing their homes than might have done so 2, 3, 4, 5 years ago, you get that imbalance. And that's put the real pressure on growth in Brisbane. And that rate of growth isn't likely to fall away anytime soon.
So the rate of growth, sorry, Phil, go on.
No, go ahead.
The rate of growth right now is in excess of 20% and has been since May 2023. There's no evidence of accelerating any faster than around 20% than what it is right now, but there's no evidence of it falling back either. So when you talk about distance, acceleration and speed, we're not accelerating any faster, we're not decelerating, and we're just cruising the highway at a fairly steady rate of growth and with no evidence of change. So we're not applying the brakes yet, but we're not pushing down any harder on the accelerator. So you're getting a fairly constant rate of growth.
Yeah, you'd have to assume, though, 20% of consistent, predictable growth. That's pretty good going.
Yeah, and it's uncommon. Yeah, you look over history,
uncommon.
It happens for short periods of time. So while it's good right now, it's not a forever thing. So enjoy. If you've got something there, sit back, enjoy, ride the wave of growth, smile sweetly and pop the champagne. If you're looking to get in, there's still a period of time for you to access that sort of growth. Again, there's no indicator specifically that says it'll slow. However, over the next 6 to 12 months, it is likely to ease a bit. That doesn't mean it'll drop into single-digit growth anytime soon, probably about 12 to 24 months before you see it come back a little, step back into lower rates of growth.
Now, someone asked me...
But it's similar to Perth.
Someone asked me the other day, Brennan and Phil, whether the upcoming 2032 Olympics was part of the reason why Brisbane
it's the only
was
reason,
experiencing
Simon.
growth. Or if that would be a reason in and of itself to be getting in now in anticipation of growth off the back of that. And the issue with that, and because a lot of people hold to this idea that when you have a major event like the Olympics in a city, that it somehow is massively good for the property market. History says no. That's not been the case in other cities that have hosted Commonwealth Games or Olympic Games, these sort of major events. And part of the reason for that is the existence of this event does not in and of itself create a reason for people to want to move there and live there and buy new homes there as permanent residents. So it doesn't drive owner-occupier demand. A lot of the large volume developers and properties brokers out there, though, will use it as a marketing tool to try and attract investors in things like high-rise units. And we did see that in the Gold Coast. We saw that in Sydney around the time of the Olympics there as well. And that attracts a whole lot of investors in to buy these things, but it also means that you've got an awful lot of development going on, which just increases supply. And you've got to keep bringing it back to prices go up when there's a shortage of supply relative to the demand. If you just bump up supply, you bring in some temporary demand from investors for that. How's that going to impact the overall market? It isn't going to. And you could find yourself paying a premium for an off-the-plan apartment that you just sit on for the next 10 years that doesn't really go anywhere in value as a result. So my recommendation would be don't get sucked into the Olympics hype when it comes to your property investing decisions.
Well, there's some sage counsel there, listeners, because I was going to actually ask you about that, Simon, because people get obsessed or absorbed into this big sell of going, oh, yeah, look, there's going to be all this infrastructure development. It's going to create all these jobs. And, you hear the well-worn narrative around it all. So your position, your thesis is, and based on what you've seen historically, that don't get caught up, don't get swept away and all that. There are other real fundamental drivers which are shaping and changing Brisbane market activity, which have very little to do with the fact that they're going to get a big sporting event. Exactly right. So when will it change then? Yeah, so Brendan said sort of 12, 24 months before the rate of growth will slow, but there will still be growth.
There will still be growth, correct.
Again, the question is, Brendan, when are you going to know when, okay, your money's probably better off elsewhere?
Yeah, cool. So when you get to a rate of growth that is trending down in your low teens or high single digits, that's probably when you want to sell out. That would mean that there's enough momentum to be a cooling market. Where it, as I said, was steady at around 20% per annum right now. That will ease ultimately over the next, maybe slightly over the next 6 to 12, and then step back further, 12 to 24 broadly. Monitor the volume of listings, though. If you monitor the volume of listings, that's going to be the key driver or the key indicator. It is a live statistics. It is a weekly statistic. You'll be able to monitor movement on that fairly comfortably. To that end, you'll be able to see fairly early if listings start to increase. As I think Simon said, we're about 25% down since September 22, which is half of what they were at pandemic levels pre-pandemic. Investors are really active. There's about $1.5 billion lift since pre-pandemic from investor purchases, and it's still climbing. So we're not there yet, but we will see that plateau out over time.
So your counsel to me would be, don't sell my Brizzy properties, hold on.
Oh, yeah, now's not the time. I appreciate let's take the money and run, but there will be a better time in the future to take the money and run. Again, if we talk distance, because distance is the cold, hard dollars that will hit your bank account, you don't want to wait until you've stopped moving forward to say, I've reached the distance, because by the time you list it, the market started to come back.
Yeah, and even if the rate of growth comes back a couple of percentage points, we're not really factoring in compounding growth.
Correct.
Which is the distance bit.
Correct. So we need to wait until we're at high single digit rates of growth, or we've got enough listings that you've got an equivalent between sales and listings volumes that are heading towards a plateaued market. Then if you're a person who wants to ride waves of growth by buying well and selling at the right time, that would probably be the time to sell out and look for something else.
Oh, so the next capital city, Adelaide, and Adelaide's I'd say it's a unique capital city in that it doesn't have its sort of feast and famine, its big peaks and troughs. It's just its rate of growth over, I think if you look at the last 10 to 15 years, is probably one of the more predictable capital cities. And I know most people who have invested in Adelaide have had and done pretty well out of there. Simon, what's your sort of view of the Adelaide market? Where is it in the cycle of sort of growth or speed of growth?
Yeah, so I think what we've seen over the past 3 or 4 years has been a very different Adelaide market to the longer term perspective. And this is one of the things with, they say that past performance is no guarantee of future performance. And you've really got to understand, these dynamics, this balance of supply and demand that's driving the market to get a good sense as to where it's going to go and why. What we've seen really since early this year has been an acceleration in the rate of growth. So it picked up considerably coming out of the pandemic. We saw, I think, around about 15% growth over the last 12 months in aggregate, but it's actually accelerated since the beginning of this year, and it's going up to what would be annualized, the equivalent of about 30% per annum right now. So extremely high growth. From what we're seeing in the underlying trends, though, Brendan, I think we'd say that rate of growth is getting very close to its peak.
Oh, yeah, we are very close to the top of that market. Adelaide cannot sustain 30% per annum for long periods of time. It's an uncommon reach for it. It hasn't done that. The last time it did that was 21. Right now, there'll be a short window where it's that hot, and then it'll come back. The rate of growth is very close to its peak. So we will start to see it ease back into the 20s and probably into the high teens over the coming months ahead. As a concept, it'll ease back over the next 6 months. Growth will then ease into greater than 10% for some time to come yet, probably another 9 to 15 months. But if you monitor listings volumes again, you're able to see when it comes back into single digits, and that's probably when you'd want to act.
So this is what it's all about. What do you do with all this information? How do you execute off the knowledge or the wisdom provided by Brendan and Simon? So the question, if you look at the Perth, the Brisbane and the Adelaide market, like any of them, it's pretty smart buying. If you've been buying in those markets, you've probably done pretty well. But speaking specifically about Adelaide, is all of Adelaide, Brendan, operating at this cadence of growth? So how do you actually peel back the layers so you can actually work out there's going to be certain suburbs which are going to be way outperforming that, There's going to be suburbs which are, being negative or detrimental to that sort of holistic growth. So how do you know where's good in Adelaide?
Again, it's a relationship between sales and listings. But if you're going to know where's good within Adelaide, that is a lot of research to do on an individual basis to look at what is the listings in this suburb right here, right now, for the hundreds of suburbs that exist in Adelaide. It's a tough ask to find that. However, if you are interested in a particular suburb because it's a certain budgetary value for you, or because you've got a knowledge about the area and you're interested in that, I encourage you wholeheartedly to look at the listings and sales relationship.
And most importantly, how it's changing.
If you can monitor the listings for a period of time, monitor sales through SpyMag for, again, what's sales done over the last 12 months, you get an idea of the nature of the market there fairly quickly. And then you'll get an idea of where it's grown, median price movement, where it's grown, how it's grown. There are still a number of suburbs in Adelaide that are going down in value. There is a lot of them going up in value, and not all of them are doing that rate of growth right now. Some are doing more, no argument, but the majority are hot. There's a number of them that are warm, but don't make the assumption that everything is going up, because it's just not.
And imagine, I want to talk about the Sydney market, and we could probably do a whole podcast on this, but I would imagine it's a very similar story in Sydney. There'd be very mixed performance depending on the specific market. There'll be markets going south, there'll be markets going north, there'll be many of the markets in Sydney which are just plateaued or stable. Brendan, is that the read for Sydney?
So if we got Sydney and have a quick look at that, the rate of growth right now in Sydney is at about 15%, so it's really quite warm. But again, we're talking acceleration, and is about 15% aggregated out. It's done well, but it has been slowing. There's a general trend of steady growth since March 24, with slowing growth over the past few weeks. I put that down to seasonal winter. The rate of growth is mixed across suburbs, but it's an overall warm feeling. Real estate agents right now are feeling, I think Sydney's okay if you ask them about the broader market. But there'll be some pockets that go, a bit nervous about this particular suburb. Population growth is one of the drivers for that. Listings are stable right now. So what we're seeing in Sydney, different to the states we've already gone through, is that the listings are static, and they're about what they were pre-pandemic. So you're not experiencing a shortage, which is driving price up. So you're fearing a sort of a plateau type environment, which gives you, as you said, the mixed outcome in a variety of suburbs. You've got less chance with the dartboard model this time. Yeah,
well, the dartboard model, it has served some people pretty well, but not many. Sydney's an interesting place in what's this sort of three cities type approach of the Sydney CBD, Parramatta, and the new city out towards the new airport. It's quite unique Sydney in that regards, how it's growing, evolving. You're not seeing sort of similarities in places like Melbourne, even though Melbourne will be bigger than Sydney at some point. Already is.
I don't know if you picked up on it. There was a ABS change recently, which included the outer suburb of Melton into Melbourne not so long ago, and suddenly Melbourne's population is higher than Sydney's. But that's not because there's more people there all of a sudden, or they've all come flooding to Melbourne. It's just because they changed the borders. I was most amused by that.
Yeah, well, Melbourne just wants to be bigger and better. I want to talk about Melbourne, but I'm going to leave Melbourne right to the end, because Melbourne's its own mixed bag there.
It is right now, yeah.
It is. So let's part Melbourne. Go to a quick break, everyone. Stay with us back in a moment. Welcome back. Phil Tarrant from Smart Property Investment, chatting with Simon Buckingham and Brendan Kelly over at Results Mentoring. Now, we're going to leave Melbourne to the end. So let's get through some of these other, I call them smaller capitals. Please don't send me any hate mail. Hobart was the darling for many property investors for many years. Imagine a very different story these days, Simon.
Yeah, look, it sure was. And it as one of the more affordable capitals as well, it performed extremely well, double-digit growth, and a lot of people were able to capitalize on that and do very, very well. But really, it's not enjoyed that so much since the pandemic. And it's had much more, I guess you could almost call it anemic growth since then. The current rate of growth is barely 1%. And the sentiment in that market, particularly if you speak to real estate agents and sellers, is much more cool or flat. So things are taking longer to sell. They're a little harder to sell. You've also got, unlike some of the other capitals, you don't have as quite a tight rental market. So your rental growth isn't as strong either right now. You've not had the same sort of population changes that you've had in some of the other hotter centres. So post-pandemic, the population in Tasmania and Hobart in particular hasn't really changed all of that much. And the supply of housing, the number of listings actually in the market, so established and new properties combined, has actually been trending up. So you've got this different set of dynamics compared to many of the other centres where with a lot of the other centres, they've got real shortages of stock in the market, but persistently high levels of demand. It's not that picture in Hobart. You've got increasing supply in the market. You don't have a lot of strong investor activity. It's kind of plateaued out to around about the same level of activity as it was pre-pandemic, that it's not increasing. And so because you've got that balance of increasing supply and you don't have that demand side pressure, prices are just kind of meandering sideways.
So is Hobart a buy, or is it going to be like Darwin was for a decade and do nothing, Brendan?
It's a watch.
It's a watch.
It's a watch. Yeah. I mean, okay, good. Great question. Depends on what you want to do with the property you purchase. If you want to do a reno, it's great because prices aren't going to come down and erode your profits. If you want to do a development, it's okay too because you've got negotiation capacity to buy really well, and then you can do your develop and sell and know that prices aren't going to dive on you, which is also great. But if you're looking for a buy and hold investor or investment to sit and watch the growth and enjoy the wave, you're not going to get a wave. It's going to remain fairly flat. So it is a poor investment of parking of money. There'd be other cities, other suburbs in the country that I'd be encouraging people to attend if you're going to pour money into it, to park it and enjoy a market-driven wave of growth.
And there's utility of this information in my sort of remarks at the start of the podcast. Some investors are going to be chasing, rate of growth, deploying money to get the biggest uplift they possibly can, whereas other investors who may be a bit more mature or sophisticated might be doing what Brendan just mentioned. They might be looking for development stock. You're going to be viewing this information very differently depending on what the outcomes are you're chasing. Now, Canberra, I saw a thing the other day. Canberra is one of the more expensive places in the world to live these days. What's going on with property markets down there, Simon?
Yeah, look, it's been flat for a little while over the past 24 months or so. It's starting to show a little bit more of a positive trend right now, but low single-digit rate of growth. So certainly a little bit of improvement in sentiment, but you do still have the issue that there's a reasonable amount of stock in the market, and it hasn't had the same sort of shortage that some of these other, I guess, booming centres have had recently. Rent growth also has not been as strong as some of the other centres. They've had higher vacancy. So you haven't had quite the same level of rental shortages to really attract the investor market there as well. In terms of...
Sorry, Simon, just 2 seconds. The rent growth in Canberra right now is around about 2.5% versus the national average of 8.2%. So it's a really subdued rate of growth there. So there's supply. Sorry, Simon.
Yeah, no, and you're exactly right. So if you look at what would attract more buying activity, you don't have the strong rental growth to bring in investors. You've got a population that has been trending higher, but it's not really all that different to where we were at through the pandemic. You've got more stock entering the market, so the new listings that are coming in are adding to existing listing stock, and some of those listings are aging. So your overall listing volumes are trending up and have been doing so really for the past 2.5 years. So they're just under the sort of long-term pre-pandemic averages right now. Investor activity, again, partly because of the lack of a strong rental yield driver, is pretty flat and remaining so. So there's not a lot of triggers there that would form the basis of an expectation for a sudden spike in value, a brand new, really strong wave of growth right now.
Yeah, and I think that will be Canberra for the point in time. And again, it will go back to the point, where's the opportunity there? It's depending on what you're trying to achieve. And when you think about somewhere like Darwin, I reckon Darwin is probably, they're very different cities, but I imagine the markets are quite similar, Canberra and Darwin, in terms of the speed of growth or the rate of growth or market direction where those opportunities are. Would you guys ever recommend Darwin as a place to be, Brendan? Is that a...
You need to watch the drivers, yeah? So Canberra's drivers are different to Darwin's drivers. Canberra's drivers are bureaucratic. If you've got a government that says we need more support, let's invest in our bureaucracy so that we can provide better services to more people, let's employ more people, you'll see house prices go up because it will be the driver of demand. And that's when you want to jump into Canberra, when you've got a change of government and a pro, let's build better services and be a better service provider, then you'll see a lift in Canberra prices. They'll pay their people more. They'll offer more people more jobs. Come to Canberra, work in the ACT. And that's how you get the population growth, and where the money goes, people will follow. So to that end, then you'll get a lift and a higher demand in property prices. Darwin, however, is different. Darwin is broadly a plateaued population. People don't drive up to Darwin for the purpose of, I want to see the crocodiles up there and stay forever. But if there is an environment that says we need to enhance our ADF, the Australian Defence Force says, you know what? It's a strategic position we need to be. Let's invest people up there. Broadly, for every ADF person employed up there, 10 people need to exist in Darwin to service that person. So you've got a scenario where if you throw thousands of people to the ADF up there, then you've got a lot of infrastructure required, which means population growth, higher demand, higher activity, and that's when you'll see the lift in Darwin. And you've seen that a couple of times over the last 2 decades. But we're not there now, though, and therefore you're not going to see significant movement in Darwin. So when you're talking about Darwin and Canberra, yeah, they're both politically orientated, and however the politics works at the time, they're the basis of the drivers of growth there. But as there's no change right now in either of them, that's the nature of the market broadly.
Yeah, you can see how, both of them are influenced by levers pulled by the government, but they're two very, very different levers, which will and can be deployed. And we're sort of entering an election cycle. There will be a federal election at some point soon. Whether or not the current government will be the government that goes into the next term, who knows? And you've got to watch these things because it will change. Whether or not they're decreasing or increasing public servants will influence Canberra markets. Whether or not security issues continue to become more complicated and involved, that's going to shape and change the Darwin market. I wasn't aware of that number of, for every employed ADF member, there's 10 sort of supporting people around it. That's interesting. The same thing used to...
Significant influence.
Yeah. The same thing used to, whether or not it did, but during the World Wars, for every frontline soldier, you normally had 10 people sort of supporting them, getting them up to getting the food and the ammunition up to the front line and everything connected with it. So maybe there's consistent. Now, Melbourne.
Well, before we do, one final comment about the Canberra and Darwin markets.
Yep.
They are similar to the Hobart market. They're not going to decline rapidly. So if you want to invest in those because you happen to live there and you know the neighbouring suburbs, or it's a budget that works for you, by all means go for it. But you want to be more sophisticated in your investing activity and do your add value projects. You're not going to see a dive, but you're not going to see a growth either.
So you've got to manufacture equity if you want to operate in those markets rather than just wait for the equity to increase organically. And again, we could probably do a whole podcast. Now, we could probably do a whole podcast on Melbourne as well. I've been scathing about Melbourne recently. The long hangover of COVID continues to exist, and even some of the stuff I'm hearing coming out of the Premier right now, I've got to sit there and scratch my head and question it. I don't know how bright it is down there. No doubt at a point in time, it's going to be a really good time to invest in Melbourne. Simon, what's your view?
Yeah, so be careful because I live in Melbourne.
I know. I was being very...
and you've pushed these buttons.
I was being very, very, very conscious and cautious about my commentary. I think Melbourne's a great place. I just think it could be doing better than what it is.
Look at
You need some more
and-
property taxes down there. That should help things.
Yeah, that's the answer.
Yeah, more tax property investors more.
That's
you
right.
need to give Simon a soapbox.
I feel the same sort of frustration, Phil, that you've alluded to there. I mean, Melbourne's a fascinating market right now. It is a market of contradictions. It's had some pretty strong rental growth, and yet investors aren't particularly active. In fact, the rate of investor activity in the Melbourne market has been declining for the past 6 months. It's had pretty reasonable population growth, and we're now getting a lot of the internationals coming back in putting pressure on various parts of the market in terms of things like rental supply. We haven't had a massive spike in listings, and by historical measures, the number of listings in the Melbourne market is not high, and it's not increasing all that quickly. And yet prices have been trending more or less sideways or slightly down over the past few months. And it's noticeable in the unit market and the housing market. So units are a bit more of a struggle at the moment, and particularly off the plan sales for developers are a struggle, although there's a number of reasons for that right now. But if we look at why is Melbourne so different to some of the other centres right now, a big part of that from our analysis is that you've basically reduced the competition between investors and owner-occupiers in this market by essentially disincentivizing investors. So, for instance, that we had at the back end of last year, the Victorian state government introducing much higher rates of land tax because you've blown your budget and you've spent money unnecessarily on things like giveaways for people just to check a website for their energy bills. Then why not go after all those incredibly rich investors, because surely they'll be able to afford higher land tax rates. The issue with that is that you've had particularly investors who have higher value properties or multiple property portfolios. Many of them have seen their land tax bills double or even triple when they got their new land tax assessments in January this year. And so that's caused a lot of investors to reassess their cash flows and their appetite to either hold on to all the properties that they already have or the higher value properties that they have, and then have to wear that additional cash flow burden or increased negative cash flow burden, or they've had to look at that as that's an additional cost of ownership and it's a disincentive to go and then invest in established properties or to invest in creating new homes for rentals. So I thought we had a housing crisis in this country, and we were supposed to be doing everything to try and stimulate more housing supply, both in terms of making more rental accommodation available and incentivizing the development of new housing for both renters and owner-occupiers to help ease some of those supply-side constraints. So it baffles me that you would implement policies that actually act against that by disincentivizing investment in established housing and by disincentivizing new builds. But there you go. I'm not a politician, so I'm sure there's some sense in this.
There's often no sense in politics. And often, unfortunately, I think the bureaucrats behind the scenes often don't have the experience to view some of the decision-making with a more pragmatic approach. And look, we could spend a whole podcast talking about the politics of property in Melbourne. But what I would say is that this is a moment in time, and this should cascade and extrapolate out with maybe some more favourable decisions are made and or the market becomes normalised. Brendan, when do you think is going to be a good time to be investing in Melbourne?
Oh, you're so great. It is interesting. There are people across this country who are not across the tax laws in Victoria. And there are people across this country who are looking at the aggregated rates of growth across the country. And they're seeing Perth's really hot right now, hard to get in. Brisbane's really hot right now, hard to get in. Adelaide's really hot right now, hard to get in. The others are relatively cool. Melbourne's in decline, but Melbourne's one of the biggest cities in the country. And if that's in decline, suddenly that's becoming more attractive. So irrespective of the tax laws, you're starting to see a lift in interest from investors towards Melbourne right now. So the nature of where Melbourne is headed at the moment, while we are currently in a gentle rate of decline, 1% to 2% at the moment per annum, in the coming month or two, you're likely to see this plateau out, and you'll start to see gentle growth probably by the end of the calendar year. So we will see the Melbourne market start to lift. Within around about 2 years from now, you will start to see Melbourne prices explode. As Brisbane continues, Adelaide continues, Perth continues, and Sydney starts to pick up into a higher rate of growth, Melbourne will be left behind a little bit longer, and it's going to be a bit like a slingshot, where you get the more stretch on the rubber band before it gets released and starts to spring back up to the rest of the country in its rates of growth. So Melbourne is the perfect time to be buying right now and working on the opportunity for negotiation and hard negotiation with desperate vendors saying, I need out, this sucks. I don't like watching my property prices go down. I need my money to do something else. So please buy my property, and they'll drop prices and you can buy in. Given that the market's likely to only decrease nominally over the next few months, then if you negotiate well, you're forward buying at a lower rate, which gives you the great opportunity before markets climb. So if you're looking for an opportunity in this country, despite the taxes, and I appreciate the pain that is, if you're looking for an opportunity in this country for growth, you will find that buying in Melbourne in the very near future, if not this weekend, would be a great time to be getting into the market.
Well, interesting you said that. It's a market that I'm sort of considering at the moment. And the point is that property taxes will become normalized. It just becomes part of your calculations for the cost of whole properties or influence on whether you got negative or neutral cash flow or positive cash flow. It's just another business expense you need to throw into the mix. And if the numbers stack up, then that makes sense. Now, I'm told, Simon, that you've got a report where you probably sort of speak very specifically about suburbs. I'm really intrigued now to see whether or not there's anything in Melbourne in this. It's the sort of the next boom suburbs or hot boom suburbs, the 11 of them. Where can I get my hands on this? Because it sounds like the sort of stuff I'd be intrigued to see.
So you were asking before about, how do I tell which suburbs I should potentially be focused on, given that every suburb could be performing differently. And I don't want to go to the ones that are likely to decline. I want to focus on the ones that are going to increase. So we thought, as part of today's session, why don't we try and help people out with a bit of a leg up and some of our latest insights and forecasts that we've got around the country, a handful of suburbs that have popped out of our analysis as being some of the ones with some of the greatest growth potential over the next sort of 6 to 24 months. And we've put them together in an easy-to-read report called Australia's Next Hot Boom Suburbs for 2024. And I want to make that available to the podcast listeners. And if you'd like to grab a copy of that and get some of those latest forecasts, latest insights, just head over to resultsmentoring.com/boom. And you'll be able to register and receive that report. And we thought we'd throw in a little bonus as well. Anyone who registers at resultsmentoring.com/boom for that free report also gets the opportunity to sit down with one of our team virtually over the phone or over Zoom and have a free strategy review with one of the mentors from the Results Mentoring program. So normally we just work with our membership, but we're going to make ourselves available to give people a little bit of a one-on-one, have a look at where your investment portfolio is at. If you've already got properties, get some expert analysis on that portfolio and its performance and even the outlook on the suburbs where you're holding those properties, and help you strategize next steps to grow your portfolio, or even if you're just starting out, what are some pointers to help you get started in the best possible way?
So I'm not going to ask you whether or not there's any Melbourne suburbs in there, because you're probably going to tell me go and download the report and find out for yourself, which I'm intrigued. Resultsmentoring.com/boom. I'm going to go and do that. That's I'm intrigued now. So But I like catching up with you guys. It sort of just affirms some of my my thoughts or sentiments towards the property market at any given time. So it's beneficial. But for our listeners out there, I hope that is of interest. And I'd certainly go and check that out. Go and download the report, resultsmentoring.com/boom. No doubt, plenty of good stuff there from Simon and Brendan. Gentlemen, it's always good to see you in the studio.
Always a pleasure, Phil.
And a pleasure, Phil. Thank you.
And no doubt we'll catch up again soon. Well, just resultsmentoring.com just is at the usual normal website. Everything's there. Go and check it out. You'll find out exactly what you can do with these guys. Thanks for tuning in, everyone. Remember, smartpropertyinvestment.com.au, social media, just look for Smart Property. You'll track us down. That's how to get your info. I will see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.